you run a company and you want to increase revenues, what's the easiest way to do it? Well, you could create a new product, or you could invest in marketing, or perhaps you just hire a ton of salespeople. Still, there's an easier and more elegant way for companies to maximize revenues, which is hiding in plain sight. Just raise the price of the products and services you already sell. Most CEOs would say that this is easier said than done. Raising prices can increase revenues, but raise your price too much, and you end up driving all your business to the competition. Topline Strategy is a consulting firm that helps its clients figure out exactly how much they can charge. As the name implies, Topline helps clients maximize revenues without driving away valuable customers. Today, I'm speaking with John Klein, CEO of Topline Strategy, a veteran of Boston Consulting Group and numerous software companies, to discuss price optimization. Specifically, we'll discuss a recent article from Topline about the 4 questions that companies need to ask before they consider a price increase. We'll also look at a real-world example where a client of Topline was going through the ringer with its value-conscious customers, but was able to achieve a major price increase. Thanks for joining us today, John. You recently wrote about the 4 questions that a company should ask when they are to see if there is a price increase opportunity. Can you tell us what those questions are and the answers that companies want to be looking for?
Yeah, so the 4 questions are really come down to how happy are your customers, how differentiated is your product, how important is your product to them, and then how hard is it for them to switch. And the answers to those 4 questions help decide whether or not you have an opportunity for a price increase.
Do all the answers to those questions have to be yes for a company to increase their price?
No, they don't. Really, what you're doing with those 4 questions is you are measuring the elasticity of demand. And so if you go back to microeconomics, inelastic products are ones where you can raise the price significantly and very few customers will change. Elastic products are ones where a small price increase will cause a lot of customers to leave. Those 4 questions are meant to give you an idea of how elastic and inelastic your selection is, or how your product is. And there's different combinations yield different results and different levels of elasticity. But generally what you find is the most important one is if your customers are happy. If customers are happy, they are very, very reluctant to leave because there's too much risk. It's working for them, and why would they go somewhere else? If the product is highly differentiated, you really can't get it anywhere else. And we've seen examples of companies where they had to have one for regulatory reasons, and it was absolutely the only product on the market, and their customers hated them, but they could raise price all they wanted because they had no place else to go. So you can there are different scenarios where you're going to have different ones work for you.
When people are looking at the question of a price increase, certainly, most companies are seeking to maximize revenues, but there are other metrics as well. I mean, obviously, there's profitability, market share. What determines what metrics the client is going to prioritize, and how does that affect your approach to determining an opportunity for a price increase?
Yeah, so if you're running a tech business, the way that you want to think about it is you need revenue in order to hire engineers, build your customer service organization, and really service your customers well. But you also need a lot of customers because that's the foundation of building market share, being able to bring out new products and new capabilities. And so it's really a trade-off between these 2 things. So what we advise clients to do is there is some price where when you start lowering it too far, you start giving up a lot of revenue. So it's okay if you take sort of the economic model or that comes out of our type of work and say, I'm going to give off sort of 5 or 10% in order to get sort of twice as many customers. But what you don't want to do is you don't want to raise your price to lower your price to the point where uh, your revenue stops. You're really trading off revenue for customers in a big way. That's what you
So,
want to avoid.
there are cases where there's uh, intentional underpricing with the intention of essentially buying market share, but there are companies that are underpricing with that goal, but they still are not charging as much as they could. It's just to their own detriment.
Yeah, they've made a decision to pull in customers or acquire customers instead of maximizing revenue. But unless they've got an unlimited source of capital and are happy to continue losing money, they can't service those customers, and then they are eventually going to lose those customers. And so at that point, it becomes counterproductive to do. And what you really want to do is think about how do you find that point where you get as much share as you can, but really have the base for building a very successful business.
There are companies that are probably watching this, management that's probably watching this that are thinking like, yeah, that I mean, it's all well and good. You can determine that the value that we provide the customer is well in excess of what we charge, and there's a price increase opportunity on paper. But, John, you don't understand our customer base. I mean, these guys are rough, they're brutal, they're always, fighting us down and haggling on price. Have you? Uh, is it a self-selecting group of clients that come to Topline, and you don't see clients like that, or have you helped any clients that are facing that kind of leg breaking client situation on their side through a price increase?
Yeah, yeah. So I think you said the magic word there was haggling. And I'd like to sort of differentiate between haggling and negotiating. There are certain industries out there, and really anyone who's in a low margin business. So you see it in construction, you see it in retail, you see it in wholesale, and then a bunch of others as well, where their success is always around is squeezing cost and getting that bottom line down. And so there is a cultural norm in those sorts of areas and nations, which is you always try to get the last, nickel out of the dollar. You always try to get 5% off. You never pay retail. You never pay list. It's just not part of your culture. So when you interact with those people are haggling. And I'd like to differentiate that from negotiating, which is people who are negotiating are seriously considering not buying from you. Like they are looking at their alternatives and they're working their way out. And they're trying to figure out if they can make a deal. The people who are haggling have already decided to buy from you. They're just fighting for that last 5 or 10% because that's their cultural norm. So, however, if you're sitting on the other side of the table and then you live with those people day in and day out, it sometimes can be really hard to tell which is which. And so you have customers on one side beating you up for every nickel. You have sales people on the other side telling you the reason they lost the deal was because of price. And you think that these guys are super price sensitive. But we've done, I'm thinking of a recent project we did where a company was selling into one of these low margin businesses. And when we started the project, this is exactly what we heard. But when we went and interviewed the customers, what we heard was, could you spend 25, 50, 75% more on this software product in order to get the best product, right? To get the one that had the best features, had the best service, that was the most reliable. And the answer was very, very clear that they were willing to do that they recognized that the value of that to their organization was so high and the total cost relative to their cost structure was so low that the extra, what they spent on this was less important than the price. That was mind bending to our client because they have been conditioned by working with people who are haggling for them for every nickel. to get the price as low as possible. And so they thought that they had to be the low price provider. And that's the only way to win. And in fact, as it wasn't. It was just about being the best provider and then understanding that they're always going to ask for 5 or 10%.
That reflexive haggling on the part of clients. I mean, I guess like, you develop optimal pricing and then you build 10% onto it to give it away, or are they?
Yeah. It's like those rug shops, right? They're always going out of business, one after another. You're going to get 60% off. It's just the way they do business. And you just have to be aware for that. But yeah, that's exactly it. You put an extra 5 or 10% on. You give your sales reps a little bit of discounting room, and that's the way you operate.
It must have been great for the client to realize they had the flexibility for a price increase. Were they crying when they realized how much money they had been leaving on the table prior to that point because they were pricing too low? Or
I would describe it more as that it was relief. I mean, they had built a successful business, and I don't think they were looking in the past and saying oh, if we just charge more. But what they looked at and said is, okay, now going forward, when the clients are beating us up on price, I can be more confident to hold my line or give them a little less. When the sales reps are beating us up to lower price, I can go back and talk to them and say, hey, that's not what the issue is. That's not why you're losing deals. These are the reasons why. This is what you have to do to win. It's not about giving them it's not about lowering the price and trying to match the competition, because we have the best product.
I'm David Zweifler, and today I've been speaking with Jonathan Klein, CEO of Topline Strategy. John shared his insights about how to know if your company can increase prices. If you'd like to learn more about the 4 questions, quantifying elasticity of demand, or the more in-depth analyses that allow you to create actionable insights, check out the links in the description.